We have with us Raunak Onkar, the research head at PPFAS Mutual Fund, joining in right here in the studios. Raunak, what a market move, right? We've absorbed Urjit Patel's resignation. We've absorbed the setback for the BJP in the polls. And now this is where we are. What a recuperation from the recent lows. Do you think that most of the bad news, at least in the short term, I mean, we still have 2019 elections, but of course, in the recent past, whatever bad news we had to take in has actually now gone behind us?
It's very hard to say that, right? I mean, anything can come up going ahead, because we've just had recently ILFS kind of situations happening, and people still worry about liquidity concerns in the NBFC space and things like that. I don't want to comment about it. What I think is, when we look at businesses for the longer term, we probably anyway have to keep investing, despite what the news cycle dominates at that moment. And just like business managers have to run businesses irrespective of the news cycle, fund managers and investors also have to keep investing in the same manner. So yeah, we will probably get some interesting businesses available at decent valuations if that happens.
No, but how have you managed your portfolio in the last 6 months? Because there's been enough damage in mid caps and small caps. So have you increased cash levels? Have you booked profits? Or have you kept your portfolio largely intact? And in fact, you know, all the incremental inflows have been allocated at lower levels.
So we've entered that phase fairly with a large amount of cash in the portfolio, about 30%. And we have been selectively buying the portfolio stocks that we already own.
Since when?
Since the past 3 months. So we've been adding in the portfolio, and the new inflows also keep getting allocated. So at the moment we have about 26% or 27% cash, which also includes arbitrage and things like that. And we have been adding to the portfolio companies that we already own, which we felt were still reasonably valued to add to them.
What have you done with your exposure to financials?
We own private sector banks and financials, and we have exposure to Bajaj Finance financial subsidiaries through Bajaj Holdings and Maharashtra Scooters. So we have kept on holding on to them and added where we thought was possible to add.
But then, you know, you mentioned that there is still that fear of a liquidity crisis in the market. You know, while most do believe that it's settled now, it's more or less eased, you still believe that this fear is still there in the market. But you still do have your exposure in financial names like you just flagged off. So what is your own sense of the liquidity crisis? Has it actually on ground eased based on your conversations perhaps with the companies?
So I don't have a fear as such. In fact, I'm presuming that people might react to whatever news cycle dominates at that time.
True,
if somebody comes up with an explanation that there is still fear or there is no fear anymore. The point is, we own private sector banks which have a very healthy CASA. So the biggest holding we have is HDFC Bank. Second is ICICI and Axis Bank. So these have a very healthy CASA and a good retail franchise and a fee-based operation as well. So these companies are more or less steady in terms of the way they operate and have a large runway. I mean, this story has been played for a long time, where private sector banks are eating into the market share ceded by public sector banks. So there is nothing new over there. It's just that the story will continue, and if the valuations remain reasonable, we can add on to these ideas as well.
So would you consider housing finance companies and NBFCs? Because, you know, undoubtedly mouth-watering valuations given the recent correction that has taken place. And again, like you're saying, you know, it has eased off. There's no fear as such, at least for you. So would you consider then more NBFCs? You've already spoken about Bajaj Finance, but what about the other housing finance companies, mid to small cap names?
I think our philosophy is to go with diversified businesses. I think a bank provides a lot of incentive to invest in the financial space in terms of diversification of the assets that they have. In a sense, NBFCs become too concentrated for our taste.
Okay. Frontline consumers with high valuations, which I would imagine are a lot of consumer names, you don't fancy.
We love those businesses because they keep generating amazing cash flows, but
so
I don't have the heart to pay for.
Deal is not your thing.
Can't really pay the valuations that the market is quoting for these businesses.
But do you have a FOMO moment, like fear of missing out? Because these are compounding stories, and if you look at the consistency which they've delivered returns amidst the market volatility over the course of the last 5 years or even more, wouldn't that, you know, wouldn't you feel that you would kind of
miss out?
Yeah, miss out
and
on
even
on
at those high valuations.
I guess we've already missed out in the sense, right? So valuations keep rating, right? There are cyclical valuations as well. So
no, here's the question. Do you think PE multiples really matter when it comes to consumer businesses?
Of course they do. You can't overpay for something which grows at about 10-15% max, and you cannot pay 60 times, 100 times earnings for that. When you have good businesses available, For instance, we bought Alphabet shares, which is at 20 times earnings and growing at 22 times, 22% year on year, and a huge runway in terms of the penetration in many countries like India.
You know, see, that's part of your portfolio. How much is that?
10%.
10% of your portfolio. What about the 90%, right? My thing is, because right in the seat that you are in, we had Prashant Khemka a couple of weeks back, and he said, look, you have to look at the cash flows, you have to see the kind of return ratios they have over a long period of time, and PE just maybe, you know, makes the mirror a bit blurry, you know, to just take a call that, oh, these stocks are expensive, because they could be expensive for a good 10 years, but they could still give returns. Now, I'm not saying that they might give peak returns of, you know, beating nominal growth, but even at a time with this market volatility, and 2018 has been a nothing sort of year for markets, you would still come in with an alpha.
Maybe, but if you are not comfortable with the valuations and you have a set of principles which you want to invest by, I think it's okay to miss something which
so
you
just
think is
for PE,
overvalued.
you will keep these stocks aside.
Not just PE.
Yeah,
so
okay.
apart from that, there is some growth incentive that the company has to show, that I mean, they're supposed to grow at a certain rate at which you justify that valuation. If you do a DCF of the valuation numbers that we see today, you won't be able to justify a decent amount of growth rate. You'll probably want a 30-40% growth rate to justify if you want to buy at a decent valuation. And again, it becomes subjective exercise beyond that point.
Raunak, I'm sorry to push you here, but then where would you get that kind of growth rate in this market? PSU banks are out of the picture, right? They might be cheap. NBFCs, again, that's a problem area. So some of the high quality names are performing, and I think you have that exposure.
Yeah.
You're not looking at the consumer oriented high price names as well. Autos seem to be slowing down. M&M has already indicated to the market that their cycle might be peaking. I mean, I can't think of any space where you will get, IT and pharma have had their own challenges. So yeah, they might be cheap, but again, growth is slowing down there too. I don't see that much in terms of a possibility of a high return.
Exactly. So why then overpay for something that also grows slowly? If you can pay reasonably for something that is growing at a reasonable clip or even at a slower clip, then why do you want to overpay for something which is growing at the same rate?
So what have you added in the last 3 months except for financials, where there's reasonable growth and reasonable valuations?
We added to IT services exposure in our portfolio. We added to some of the auto names. We bought Hero MotoCorp a couple of months back. We were adding to Suzuki, the Japanese parent company.
Okay.
So we've been adding. It's not like we haven't been. The stuff we like.
I mean, it's not just last month, but for the last 2-3 months that we are seeing that slow down.
Yeah, it's fine. I mean, that keeps happening, right? I mean, these are large businesses. You cannot expect them to keep growing consistently every quarter, every month, year on year. So I think there will be some periods where they will have a lull, and then probably they'll pick up.
You would not regret HUL going to 2200 from here?
No.
Okay, all right. I just wanted also your word on the Q2 numbers, and the reason why I asked this is because we've seen this rebound of sorts of input costs coming in. Again, the fear with respect to a hit on profitability, a hit on margins, etc., is becoming real. I mean, not Q2 rather, sorry, Q3 numbers coming in, and there we may see a bit of a hit coming into profitability or margins. How would you play that entire rise in raw material costs scenario, which would hit perhaps autos, it would hit some FMCG names, and yeah, that's about it mostly. How would you play to that?
I think in the shorter term, a lot of these raw material issues, like you said, you have inflation in raw material prices. In some cases, you will also have a deflation in those prices because of the commodity markets elsewhere. So instead of thinking about them on a quarter-on-quarter basis, we take a slightly longer-term view. Say 5-10 years, can you see this company doing better? Can they keep on increasing their competitive advantage that they have? Can they keep increasing their market share and still perform reasonably well? And is it available today at a reasonable valuation? If all these things meet with the management quality the way we want it, I think we'll go ahead with the investment. Yeah,
from a long-term perspective, these quarterly issues
that's what matters to us.
And yeah, you obviously have a 5-year time horizon. Okay, how much should investors be worried about what's happening across the globe? You have that US-China trade war. Yes, there is that hard stop of 90 days, the ceasefire, but then you never know with Donald Trump. Then you have this the entire conspiracy between OPEC and non-OPEC members, where they want to keep crude prices higher. So to what extent should Indian investors pay attention to all these global cues?
So like you said, no one knows what's going to happen, right? So you can worry top down, but ultimately you have to pick stocks and you have to invest bottom up. So if you figure out that there's an interesting company available at a valuation you want to pay and the management is good enough as per your expectations, you go ahead and take that call and build a diversified portfolio. And we also own foreign parts. So about a quarter of the portfolio is in foreign stocks. So that also helps us get an exposure, something which is not India based. So if something happens over here, that exposure takes care of some volatility in the portfolio.
Okay, what about the refiners? Do you like the refiners?
We don't own them.
Okay.
So PSUs have not been great partners for us since a long time. So.
It hasn't worked for you. Well, has it worked for a lot of people?
You know, I don't see any mention of even metal stocks or any sort of commodity stocks. Is this as well on account of the variability of prices, and that leads to inconsistency in earnings? Is that a reason?
So most of the commodity businesses who are into metals or any of the sectors, these you need to be really good with identifying the cycles. So if you're good at cyclical investing, you can probably go ahead with that. We have not demonstrated that qualities yet, so we'll keep tracking. I mean, we study these businesses from the raw material angle and understand these companies and the managements, but we have not invested in cyclical stocks yet.
For that reason.
You're saying 25% of your portfolio is exposed to the US markets, US stocks. Is that going, like, are you looking to book profits there at all, given what's happening with the markets there? Because there's been a significant sell-off in the alphabets of the world.
We keep adding where we see the valuations are in our reasonable
You've added more to Alphabet, okay. And what about the other names? I think
Alphabet, Facebook, IBM, 3M, Nestle.
And you've added to all positions?
Yeah.
Oh, interesting. So you're taking this fall in the US markets as an opportunity to buy, and you're not nervous about how you know, the market is coming off a cliff. You know, especially the focus of that selling is on IT stocks.
IT stocks is a different categorization. So what they call is a techlash. What they call is a techlash in the media. So it's happening because some of the issues they have never discussed in the public media, in the public scrutiny, right? I mean, for example, the Google CEO recently was in front of a government panel. The whole idea is all these regulatory angles are going to come in, and you have to be cognizant about them and keep a watch on them. But on the other hand, is the business going to be affected? I mean, is there any other company apart from Alphabet and Facebook, or Google and Facebook, who have significant market share in the online ad space? And you have to keep track of that. So we keep looking at competition and how these companies keep building their franchises that way.
Okay, Raunak, great to have you in the studio.
Thanks so much.
Thanks very much for taking out the time to speak with us.